Hello and good day, everyone. We are pleased to welcome Rahul Agrawal, partner in Audit and Assurance at MSKA and Associates, to help us navigate the regulatory landscape through a session today on year-end updates on InSync with BDO India. Thank you for joining us, Rahul. Over to you for your valuable insights.
Well, thanks, Rajdeep. Today we intend to cover the key updates coming from SEBI and NFRA. Few key changes coming into FEMA, mainly particularly comprising of compounding process. Few revisions have been made in ADT-4, which is the form which is supposed to be submitted by the auditors to the central government in case they come across a situation where the fraud has happened in an audit client. Some changes into MSME definitions and this contribution towards the economic development of the country, and a few amendments made under Ind AS 21, mainly pertaining to the restricted currency movements. Well, in the past few years, NFRA has underscored the importance of more meaningful interactions between the auditors and the audit committees. The intention is to move beyond routine formalities and encourage active and quality discussions that enhance audit oversight. This shift is just not regulatory, but it's actually strategic in nature. It provides audit committees with better insights and allow auditors to communicate concerns more openly and is strengthening the governance environment at overall level. In its efforts to suggest measures for improvement in the overall audit quality and to promote awareness and significance of accounting and auditing standards, auditor responsibility and audit quality, the regulator has commenced a series of auditor and audit committee interactions which are being issued on significant areas of accounting and auditing from time to time. This has reinforced the need for quality interactions between the auditors and the audit committees, increasing the opportunity for better engagement between both parties, which will enable the quality of interactions and oversight of the audit committee, thereby protecting the overall interest of the investors and public at large. Let's take a moment to understand why this series was released in the first place. This interaction series aimed at enhancing communication between the auditors and the audit committees, which is launched in early 2025. The four publications tackle high risk and technically demanding areas in audit, which includes expected credit loss, audit strategy and planning, related party transactions mainly around identification of the related parties and its approvals, and deferred tax and income tax considerations. These guides provide pointed questions and best practices designed to raise audit quality and strengthen the corporate governance, ultimately serving the public interest and protection of investors. NFRA regulatory reviews and inspection reports has highlighted a common theme, which is the lack of effective communication between the auditor and the audit committees, particularly into critical risk areas. In many cases, committees were not even equipped to challenge the judgment or assumption made by the management and the auditors. This weakened the governance environment and often led to audit failures or missed red flags. Moreover, with the implementation of Ind AS and increased scrutiny by the regulators like RBI and SEBI, the companies are expected to maintain high standards of financial reporting. But for that to happen, audit committee needs to become more proactive and well informed, especially in technically demanding areas. And that's precisely what these publications are designed to support. In terms of the first guide, which focus on ECL, which is expected credit loss, this topic has gained immense importance under Ind AS 109. ECL is just not an accounting number, it's more like a forward-looking estimate based upon the assumptions, risk model, and forecast. This involves a lot of judgment, especially for banks and BFCs, and even for large corporates which carry exposure from the receivables. NFRA has recognized that audit committees often struggle to understand or even question how these numbers are derived. So this publication lays out specific questions that committee can ask the auditors about sources of data, the assumptions around default rates, the macroeconomic factors, the validation of the model which has been used by the company to derive ECL, and even whether the applicable regulatory norms issued by RBI, for example, in case of banks and NBFCs, have been really applied for. This empowers audit committee to probe deeper, uncover biasness into estimates which is possible, and ensure that credit losses are never understated nor become overly optimistic, ultimately lead to better financial reporting and risk disclosure. Moving on to audit strategy and planning, which is the second guide issued by NFRA. That's an area that sets the tone for the entire audit process to start with. Poor planning often leads to misallocation of resources, miss risk, and also delays. NFRA here encourages a more structured interaction between the auditors and the audit committees. The guidance includes talking point on the audit scope, the materiality levels, the involvement of component auditors into the group audit engagements, the use of IT systems, tools, and data analytics, and whether the engagement team who is going to deliver on the ground does carry the necessary experience and expertise for them to perform the function they are supposed to perform. By asking the right questions early on in the process, the audit committees can ensure that audit is thorough, risk focused, and efficient. This not only improves the audit quality, but also reduces last minute surprises and ensures better oversight throughout the financial year. Moving on to related party transaction, which is more like a hot area and talk in the town in the recent past as well. Well, these transactions generally may be misused to divert funds or hide fraudulent activity. The recent cases of corporate scandals, which is available in public domain, triggered adoption of rigorous mechanism for related party transactions. NFRA's third publication addresses this concern head-on. It provides a detailed framework questions that committee should ask, ranging from how related parties are identified, whether the transactions are really done at the arm's length price, which means that if the transaction would have been done between the company and the unrelated party, whether the transaction with the related party is also intended to be done at the same price, whether the approvals from the audit committee, boards, and the shareholders in accordance with the applicable guidelines are intended to be taken, how transparent the disclosures are in the financial statements, which is going to be ultimately relied by the users of such financial statements. It also urges the committee to go beyond compliance and focus on commercial substance of the transaction, including understanding the business rationale, the need for the company to get into such kind of transaction with the related party, and how does that transaction intends to add benefits for the overall interest of the stakeholders of the company. Better scrutiny of related party transactions strengthens trust in the financial statements, reduces the risk of the fraud, and enhances the transparency. Well, moving on to fourth guide, which is on income tax and deferred tax consideration. These items may seem routine in nature, but involve a lot of complex judgment sometimes, particularly around the area of recognition of deferred tax asset based upon the future taxability of the profits. NFRA stresses that committee should challenge assumptions like future taxable income, timing of reversal of temporary differences, and changes in tax laws. It also asks them to evaluate whether adequate audit evidence support the numbers in the books of accounts. This ensures that tax positions are neither overly optimistic nor aggressive, helping companies avoid regulatory scrutiny later on and ensuring more accurate tax-related disclosures. Well, overall, NFRA's auditor and audit committee interaction series is a welcome and timely initiative. It brings much needed clarity to complex audit areas, help prevent audit failures, and strengthen the overall governance fabric in corporate India. Well, related party transactions have long been a regulatory and governance focus under SEBI LODR as well, which is listing obligation and disclosure requirements. While the framework mandates prior approval of material related party transaction by the audit committees, there were concerns about inadequate information disclosure by the company's management, leading to uninformed approvals and potential conflict of interest situation. To address this, SEBI very recently, through Industry Standard Forum, has come up with a minimum standardized list of information that management must furnish while seeking approval of related party transaction from the audit committees. This move aims to bring consistency, improve transparency, and strengthen the quality of overall decision making by the audit committees and the shareholders. Earlier, while there was some requirements and the expectations laid out in the regulations, there was no uniform checklist or expectations around what companies need to disclose while presenting RPTs for approvals. Now, a minimum set of disclosure is mandated, ensuring that the critical information is always presented upfront rather than selectively. This regulation is applicable from September 1, 2025, and the audit committees must be provided with the standardized set of information, which is over 100 data points, before approving a related party transaction. This range from balance sheet data to cash flow metrics, and also can go on to a level to understand about the business need of getting into such transaction, and why such transaction with related party is going to add benefits for the overall interest of the company as a whole and its stakeholders. Additionally, three levels of disclosures are now warranted, which includes comprehensive, limited, and minimum. When seeking audit committee or shareholder approval, the management must submit at relevant details for each related party transaction, including name of the related party, the nature of relationship between the company and such related party, type and the nature of the transaction, material terms of the contract which is intended to be done between the company and such related party, what is the value of the transaction, what is the business rationale for getting into such transaction and how it is going to benefit the company and the overall stakeholders, whether the transaction is really done in the ordinary course of the business operations and at arm's length price, what is the basis for the management to say that the transaction is done at arm's length price, and whether it is supported by any external valuation report or from based upon some in-house analysis, any potential conflict of interest for directors or key management personnel, and more particularly detail of prior approvals and track records of the similar past transaction done by the company in the past. Purely from change perspective for audit committee, this allows them to assess transactions more holistically with all the relevant facts available to them, especially when the pricing or the commercial substance might be questionable. From shareholder perspective, they receive better quality disclosures leading to greater trust and participation in governance. And from the company's point of view, while it slightly increases the compliance effort, it also reduces the regulatory risk and improve investor confidence. Further, compiling necessary information head-on ensures accuracy of such information, providing supporting documentation, such as valuation report, benchmarking data, or any other agreements, would be another responsibility of the management of the company. Management may also proactively engage with the audit committees to understand their expectations, respond to their queries on timely basis, and enable informed oversight rather than treating the process as mere a compliance formality. This standardized disclosure framework is a welcome step towards better governance and investor protection. By ensuring that audit committees and the shareholders are no longer blindfolded during the approval process, SEBI is reinforcing the message that transparency and accountability start with the company and the management. Well, these are the few examples in case of the various nature of related party transaction which can happen and what kind of information which can be submitted by the company's management to the audit committees. Well, SEBI has recently clarified the role and position of the compliance officer in the listed organizations. A key update mandates that the compliance officer must be in whole-time employment, positioned not more than one level below the board of directors, and designated as key management personnel. This is aimed at strengthening the corporate governance by ensuring that compliance officer has adequate seniority and access to the top leadership for effective implementation of regulatory responsibilities. I mean, this change has been considered necessary because compliance nowadays is too critical to be buried deep in the reporting chain. A strong organizational position ensures that compliance risks are flagged at the top more at timely and accurate basis. Purely from the company's perspective, the entities may need to revisit the functional and organizational structure to make sure that it is aligned with the applicable guidelines now. And from the auditor's perspective, they need to ensure with the applicable laws in spirit and also in substance. Well, in terms of the FEMA, the RBI very recently in April 2025 introduced amendments primarily focusing on streamlining the compounding process and mandating digital submission through the PRAVAAH portal. These changes aim to enhance transparency and efficiency and ease of doing business by reducing complexities in the compounding process and promoting digital transactions. The key changes which have been introduced include mandatory submission via PRAVAAH portal, which is effective from 1st of May 2025. All regulatory application to the Reserve Bank of India by banks or financial companies or any other regulated entities must be submitted through this portal. This digital platform aims to streamline the application process and ensure complete digital transformation of the RBI's interface with the relevant stakeholders. In terms of the compounding, the amendment to the guidelines introduce a penalty cap of 2 lakh rupees for certain contraventions in exceptional circumstances. Earlier, the fixed amount of rupees 50,000 plus a percentage of amount under contravention was levied and but was silent on any upper limit, leading to ambiguity and uncertainty, which is now resolved under the current guidelines. This amendment aims to provide a more proportionate and flexible approach to penalties for minor or inadvertent violations. The changes primarily impact contraventions related to reporting delays and procedural lapses rather than major financial violations. The amendments aim to simplify and expedite the compounding process for eligible cases. In addition to this, the RBI has now delinked the fresh application to previous compounding orders. Previously, an automatic 50% enhancement on the compounding amounts was imposed on applicants against whom an order was passed, and the applicant had failed to pay the amount and subsequently reapplied for compounding related to the same contravention. With this current amendment now, each application is now delinked from the previous application on the same subject matter with no enhanced compounding amount for non-payment of amount. This amendment ensures that applicants are not unduly penalized for previous non-payment of the amount if it was due to genuine error or any financial hardship or procedural misunderstanding. Overall, this amendment marks a progressive shift towards a more transparent, technology-driven, and proportionate regulatory environment under FEMA guidelines. In continuation to what I said just above, the amendment also requires additional details to be provided to the Reserve Bank of India through an email after payment of compounding application fee or amount. Lastly, the amendments have further clarified the difference between the penalty amount and the compounding amount under the guidelines for greater transparency and consistency in enforcement of orders by the authorities. It is noted that penalty amount is the maximum amount that can be imposed for contravention of FEMA provisions, while compounding amount is the penalty that is imposed by the authorities after filing of application. In substance, RBI is moving towards a more nuanced and proportionate approach to enforce FEMA regulations. Overall, the amendments to FEMA compounding and penalty rules signal a shift towards a more flexible and practical approach to enforce foreign exchange regulation, with greater emphasis on increasing compliance and addressing minor violation with proportionate penalties. Well, as I said in the beginning, ADT-4 is more like the information which needs to be submitted by the auditor directly to the central government in case they come across a situation where the fraud is identified in their audit client. Well, this form used to be submitted manually, but very recently the MCA has come up with an online platform to submit this form. Given the increasing instances of corporate fraud and the need for stronger oversight, the MCA has revised this form as well, which is effective June 14, 2025. The updated form now mandates more granular disclosures while reporting frauds to the central government. It places greater emphasis on the situation where the auditor has obtained the comments from the audit committee and the board about the fraud or the suspected fraud, and there is a disagreement between the auditor and those charged with governance about the information which is being submitted. So earlier, while it was going more at the practical level, but now there is a specific section which talks about auditor to disclose the information in case they are in disagreement with the information submitted by the board or the audit committee. That needs to be specifically highlighted in the form itself. The revised form now explicitly requires the auditor to record these observations and provide supporting rationale in such scenarios, which brings more transparency and accountability into the fraud reporting framework. Additionally, this new version of ADT-4 requires disclosure of specific details such as email IDs of both the companies and the audit firm and information about the number of offices and officers involved in the reported fraud. The form must now be filed electronically, as I said, thereby simplifying the process and enabling better tracking and accessibility of the information by the regulatory authorities. Well, in the recent budget, the government has announced a significant revision to the MSME classification criteria. Specifically, investment limits have been increased by around 2.5 times, and the turnover limits have almost been doubled. Talking about the sector, the MSME sector contributes around 30% in the GDP of India, underlying their great importance in the economic development of our country. These enterprises, on one hand, account for 45% of the manufacturing output and almost 40% of our exports, and represents more like a backbone of our Indian economy. This expansion aims to empower MSMEs to scale up without losing out on the crucial benefits and incentives, thus driving broader economic growth and employment. It supports job creation, especially in rural areas, and simplifies governance. A strategic move aligned with the India's broader economic reform agenda. Additionally, this amendment will enable the MSME to have access to various government incentives, be it collateral-free loan, participation in the tender process, or concessions. Well, very recently, MCA has also come up with an amendment in Ind AS 21 to address the very practical issues, like how the accounting needs to be done in case the transaction is done in a foreign currency, but that currency is not really exchangeable due to various restrictions which may be imposed. Now, this is a very practical issue which has gained a lot more importance considering the geopolitical crisis which we are witnessing in the world today. And while most of the economies may not be impacted, but the question remains that the markets which are going to be impacted by this, how they account for their transactions in foreign currency. India's 21 required companies to use the spot rate to convert the foreign currency transactions, but it didn't say what to do if the spot rate doesn't really exist, like in Venezuela or countries with capital controls, where the currency can't be exchanged freely. Now the amendment talks about two-step process. The step number one, which remains unchanged, which says that if the currency is really exchangeable freely, then the transaction should be recorded at the spot price at which the transaction is really happening. Whereas in step two, in case the transaction is done in a foreign currency, but that foreign currency is not freely exchangeable, then the standard now talks about estimating the rate they would have used if the exchangeability existed. This could involve use of observable market information or another estimation technique. This amendment, which is effective from April 1, 2025, ensures financial statements reflect the economic reality and not just the nominal exchange rates, and also improve the comparability across various jurisdictions. The change could not have come at a better time, especially given the kind of geopolitical and economic uncertainties we are witnessing across the globe. With sanctions, currency freezes, and restrictions on moving money across borders becoming more common, particularly in regions affected by political unrest or international tensions, companies are increasingly finding themselves stuck with foreign currency they just can't really convert. By stepping in now, the MCA has tried to close a very real gap in the accounting rules. Of course, this won't affect most of the business since many currencies are still freely exchangeable, But for those operating in a more complex or restricted markets, this brings much needed clarity. Well, this brings us to the end of this presentation. What's clear is that the regulatory landscape is becoming more structured and intentional. As we have seen, the regulatory environment is becoming more assertive, more data driven, and more outcome focused. Whether it's redefining the role of the audit committee or streamlining the FEMA process, or really revamping the role of the compliance officers, these changes are nudging all of us towards a stronger system, better governance, and more meaningful reporting. For leadership, it's good moment to pause and ask, are we really prepared? And in case not, what are the gaps which needs to be addressed? The sooner we align with the current reality, the more confident we can be when it comes to compliance, board discussions, and the investor communication. If anything we have covered today sparks a question in your mind, or you would like to explore more, how does it play in your specific context? Do feel free to reach out to us. We will be happy to help. Thank you once again for attending this presentation today.